Gold has just exploded from $4,030 to $4,317. Silver has absolutely ripped through resistance, surging $8 from $56.50 all the way to $64.50. And the mining stocks, the sector that every analyst had written off for dead, that everybody in your comment section had declared worthless just weeks ago, have broken out to the upside with undeniable force. If you have been holding through the last few months, through the brutal drawdown, through the ridicule from friends and family, through the endless parade of experts telling you that you were wrong, this is the week the market finally started proving you right. Now, here is why I am recording this video right now instead of sitting back and celebrating. Because the price move you are watching on your screen is not the actual story. The price is just the receipt. The story, the real story that matters, is what was happening underneath that chart while it was falling. While everyone else was watching the price bleed and declaring the trade dead. And there is published data now. Official exchange data that shows you exactly who was selling and exactly who was buying during those brutal months when it looked like absolutely nothing was happening. 62 tons of gold quietly disappeared from the exchange, while retail investors were panic selling and giving up on the entire trade. The number of participants in the gold market had collapsed to the lowest level we have seen in decades, right before this massive turn. And this week, a currency intervention that was supposed to calm the system and restore confidence did the precise opposite. And it did it for a reason that almost nobody in the mainstream financial media has explained correctly. And then at the end of this video, I am going to put a chart on your screen from 53 years ago. It is the last time this exact configuration appeared in global markets. And 12 months after that setup completed, gold had doubled. I am saving it for the very end because it only makes sense once you have seen everything else that I am about to show you. Let us get straight into it. Welcome back to the channel. If you are new here, hit that subscribe button because we break down the hidden mechanics behind these moves while they are still developing. And one honest ask before we dive deep. This is a one-person channel and each of these breakdowns takes hours of research and data analysis. So if that like button is sitting on your screen right now, one quick tap helps push this information out to more people while this move is still young and actionable. First, let's talk about the character of this rally. Because it tells you something critical before we even look at a single number or data point. The mining stocks are leading this move. That matters more than most people realize. Mining shares are essentially a leveraged bet on the underlying metal. They are where informed capital, the smart money, expresses real conviction rather than just cautious hedging. And historically, when the miners lead the metal higher, rather than lag behind it, the move tends to have serious legs. A rally where the metal creeps up slowly and the miners refuse to follow is usually just a bounce, a temporary relief rally that fades. But a rally where the miners break out first, where they lead with force, that is usually a complete repricing of the entire sector. That is when the market is telling you something fundamental has changed. Silver is confirming this move as well. An $8 surge in a matter of just days is not a drift or a gentle move. And silver is actually the more honest of the two precious metals in one very specific way that most traders do not understand. Silver has almost no patience for a false move. When the underlying monetary story is weak, when the fundamentals are not truly there, silver underperforms dramatically, and it underperforms embarrassingly compared to gold. But when silver moves harder than gold in percentage terms, when it starts outpacing gold's gains, the market is not just hedging politely. The market is aggressively repositioning for something bigger. So the shape of this rally, the internal structure of how different parts of the precious metals complex are moving, is absolutely right. Now let me show you exactly why this move started here, at this specific price level, in this specific week. But before I show you the data, let me address something directly because a lot of you have written this in the comments for months now. The most common criticism under these videos has been that this channel is permanently bullish, that I keep describing a breaking financial system while gold goes sideways and does nothing and silver bleeds out on the price chart. That criticism was completely fair. So I am not going to answer that criticism with an opinion or an excuse. I am going to answer it with a specific number that was published and publicly available the entire time. A number that almost nobody was looking at. A number that explains precisely what was happening underneath a chart that appeared to be doing absolutely nothing. To read this data correctly, you need to understand one concept, and it takes about 30 seconds to grasp. In the futures market, there is a figure called open interest. It is not price and it is not trading volume. Open interest is the total number of contracts that are still open, still being held by participants who have not closed their positions and walked away. Think of it like this. Think of it as the number of players still seated at the poker table. Price tells you what the last hand was worth. Volume tells you how many hands were played. But open interest tells you how many people are still left in the room, still holding cards, still committed to the game. That distinction changes absolutely everything, because it tells you what kind of price decline you are actually looking at. When price falls and open interest falls right alongside it, that is not the world rejecting gold as an asset. That is participants leaving the market, positions getting closed, margin calls being met, stop losses getting triggered, conviction being exhausted, weak hands shaken out completely. And there is an obvious consequence to that pattern which almost nobody says out loud. When the sellers have completely finished selling, when there is nobody left to sell, the selling simply stops. It does not matter what anybody believes about the economy or inflation or interest rates. There is simply nobody left holding a position who wants to sell it. Here are the actual numbers from the official data. In June, open interest in Comex gold futures fell to its lowest level in decades. Let that sink in. At the exact moment when sentiment was at its absolute worst, when the price chart looked completely terminal, when the commentary had turned openly hostile and everyone was calling this a failed trade, the number of participants remaining in the gold market had collapsed to a level not seen in an entire generation. Then something changed. From that extreme low through the end of July, 3 categories of traders, the managed money category, the other reported category, and the non-reported category, together added more than 30,000 long positions. And the largest single group among them was the non-reported category. Out of the total new longs, 18,493 contracts came from non-reported traders. Now, why does that matter? Who are the non-reported traders? Non-reported is where the quiet, physically minded buyers operate. These are not institutions announcing a new gold strategy on CNBC. These are not hedge funds putting out press releases. This category represents individuals and smaller entities accumulating steadily in size without fanfare. And the price range where all of that accumulation took place was between $4,000 and $4,500. Exactly the level where everybody else was calling this a failed market and declaring the rally over. But it was not confined to just paper futures contracts either. During that same exact window, physical deliveries on Comex totaled 19,887 contracts. That represents 61.9 tons of physical gold that was taken off the exchange and moved into somebody's actual possession, vaulted, stored, removed from the available supply. And this happened during the precise period when retail investors were declaring the trade completely over. Here is what that means in plain language. And this is the single most important idea in this entire video. While the price was going down, while it looked like nothing was happening, ownership of the metal was quietly moving from holders who could be shaken out to holders who absolutely could not be shaken out. From weak hands to strong hands. From speculators to accumulators. That is not a collapse of the bull market. That is a transfer of ownership. And it happened in public data, in full view, completely transparent, at the exact point of maximum pessimism. Bottoms do not announce themselves with fireworks. They do not come with a press release. They look exactly like that. Quiet accumulation while everyone else is panicking. Now let's talk about silver, because silver tells the identical story, and it tells it even louder. Silver ran to an all-time high near $118 earlier this year. Then it broke hard and fell all the way back into the 50s. A devastating decline that crushed sentiment completely. Its open interest did exactly what gold's did. It collapsed through the spring to the lowest level visible on the entire chart. Participants gone, positions closed, the trade abandoned by almost everyone who was not deeply committed to the thesis. And over the past several weeks, silver's open interest has turned higher, and critically, it has turned higher while the price is also rising. That combination matters tremendously. Falling price with falling participation means people are leaving the market. They are giving up. But rising price with rising participation means new capital is actively arriving. Fresh money is entering the trade. Those are opposite conditions. Opposite market structures, and silver has just switched from one to the other. There is one more layer worth understanding here, though I want to be transparent about the standard of evidence. The market makers and bullion bank traders recorded in the data as the swaps category sit on the other side of these positions, and they are structurally short. In a physically tight market, when that group cannot easily reduce its short exposure, its own hedging activity becomes a source of buying pressure in the London market. Which means the very participants who normally cap the price rally can, under the right conditions, end up accidentally accelerating it instead. Their hedging becomes fuel for the rally. I will be completely straight with you about that last point. That is an argument based on market structure. It is not a direct measurement. The open interest collapse is a measurement. The 62 tons of physical delivery is a hard measurement. Weight those accordingly. Now, the part where I have to revise something I told you just a few days ago. When the United States Treasury moved alongside Japan to intervene and support the Japanese yen, I gave you the explanation the market was giving at the time, which was that Japan holds an enormous quantity of United States Treasury bonds, and Washington acted to prevent those bonds from being dumped onto the market in a crisis. I have spent this week reading the counter-argument, and I now think the counter-argument is actually stronger. So here it is. Ask yourself why Japanese institutions accumulated United States treasuries in the first place. It was not primarily for the yield. For years, the most profitable component of that trade came from the yen falling against the dollar. You borrow cheaply in yen. You buy dollar-denominated assets. And as the yen weakens over time, your returns in yen terms expand dramatically. That is the carry trade. And it has quietly financed an enormous share of global demand for American government debt. Now consider what an intervention that strengthens the yen does to that arrangement. It attacks the profit mechanism. It punishes the exact dynamic that was generating demand for United States treasuries in the first place. So if you are a Japanese institution or a global hedge fund running short yen positions as the foundation of a massive carry trade, this intervention does not make you more willing to keep funding the United States government. It makes you less willing. And Japan is not entering this situation from a position of strength. Japanese government debt already sits at roughly 240% of the size of its entire economy, and it is now running directly into a wall of rising borrowing costs. So instead of quietly solving a problem behind the scenes, the intervention directed a giant spotlight at Japan's funding difficulties. And standing immediately beside them, equally exposed, are America's own funding challenges. There is an old line that fits this moment perfectly. A wise merchant sits on the hole in his carpet to protect his reputation. This week, Washington stood up and pointed directly at the hole. And that is the real signal here, not the intervention itself, but what the market did with it. Every monetary system has a threshold, a line. On one side of that line, when the authorities act, markets are reassured. Confidence is restored. But on the other side of that line, when the authorities act, markets ask a completely different question. Why do they need to do that? And what do they know that we do not? Gold and silver accelerating hard in the days immediately after that intervention is your answer. We are on the second side of that line now. From here forward, rescue attempts get priced as evidence of distress rather than competence. So now, the chart I promised you at the very start of this video. Go back to October of 1973. OPEC raised the price of oil from $3 per barrel to $5, and gold did almost nothing. It drifted lower. It sat near $90 an ounce, looking completely broken. While the world argued endlessly about whether anything had really changed, every serious commentator explained in detail why the move was just noise, why the disruption would be negotiated away, why everything would go back to normal. Then the second oil price increase arrived. Oil went from $5 to $16.50. And over the following 12 months, gold went from roughly $100 per ounce to nearly $200. It doubled. The lesson in that chart is not that oil makes gold go up. The lesson is the order of events. Gold did not respond to the initial shock. Gold responded to the confirmation that the shock was permanent. And the entire move, the entire doubling, belonged to the people who accumulated during the boring stretch, when it looked like nothing was happening, when the price refused to cooperate, when everyone else had given up. Now look at where we are standing today. Oil in this cycle has been artificially suppressed by the deliberate drawdown of American strategic petroleum reserves. And that drawdown is coming to an end, because you can only sell down a reserve once. It is ending into a world where the Strait of Hormuz has been disrupted, and now Bab el-Mandeb as well. Those are two of the primary arteries through which the world's energy physically moves. So the suppression stops at exactly the moment the physical disruption widens. And it releases into a bond market that is already struggling to absorb an enormous wave of government borrowing. Higher energy costs feed inflation. Inflation feeds bond yields higher. Higher yields feed the deficit larger. Same machine, same order of events, 53 years apart. And on that 1973 chart, the point we appear to occupy right now is the one marked just before the vertical leg began, which brings me to my completely honest take. And this is where I part company with most of the commentary you will hear. Look at that same 1973 chart again. But this time, look at the middle of 1974. Gold ran from $100 to about $180, and then it fell back hard to around $130. That is roughly a 28% decline, inside the very rally that everybody now cites as proof of concept. Anyone carrying excessive leverage through that stretch was completely destroyed. Anyone who had convinced themselves the move could only go straight up was removed from the trade entirely. And then gold went on to make new all-time highs without them. That is the honest version of this historical analogy. The direction is right, the road is violent, breakouts retest, rallies consolidate. This one is still young. So if gold and silver pull back hard in the coming weeks, even 20 or 25%, that is not the thesis failing. That is the thesis behaving normally. Scale in, leave room, size positions so that a bad 2 weeks cannot force you out of a correct multi-year idea. One caveat in complete fairness. In 1973, gold had only just been released from a government fixed price of $35 per ounce. So part of that explosive move was pure price discovery. A market finding its level for the first time in decades. That specific mechanism does not exist today. So treat 1973 as a map of sequence and behavior, not as a promise of a specific percentage gain. And let me tell you exactly what would prove me wrong. Because a thesis that cannot be falsified is worth nothing. If open interest rolls over and declines again alongside price, then this was just a bounce and not real accumulation. And I will say so clearly on this channel. If physical deliveries dry up completely, the tightness argument weakens badly. Those are the two hard numbers I am watching. And I will report them in either direction. This is not financial advice. I am not a financial advisor. This is my analysis of publicly available data, and you absolutely must do your own research. But step back and look at what has assembled itself here. Participation collapsed to a decade's low and then reversed. 62 tons of physical gold left the exchange at the point of maximum pessimism. Silver has repeated the exact same pattern. The miners are leading rather than lagging. An intervention designed to steady the system was read by markets as a distress signal. And energy suppression is ending into two closed maritime choke points in a bond market that cannot absorb the consequences. The months that frustrated everybody, the sideways stretch when nothing appeared to be happening, that was not the thesis failing. That was the accumulation phase. And it was visible in the data the entire time. 2 questions, and I read every single comment. First, were you accumulating in that $4,000 to $4,500 range, or were you waiting for confirmation? Answer that one honestly for your own sake, more than mine. Second, on the record, does this cycle deliver a 1974 style shakeout? A decline of 20% or more before the larger move completes? Yes or no? And give me your reasoning so we can come back to it together. The sharpest answers get pinned. And if this breakdown showed you the actual machinery underneath the rally instead of just the headline price move, hit that like button and subscribe because this sequence is still early. And every stage of it gets broken down right here calmly and clearly while everybody else is still arguing about the price. I will see you in the next one.